So just, in case you ask questions or things like that, just to kind of give you guys a heads up of that recording. And so we'll post that webinar, as I said, in a few weeks on our YouTube channel that we have for our webinars after we kind of reviewed it. So today, hopefully everybody sees the slide deck that we have out there on the Research Credit webinar. And so if you do have questions, you should be able to type into the chat area. As you kind of see there, I've typed some things. So go ahead and type some questions if you want to do that. Or if you want to chime in through the conference call number, go ahead and do that. So if anybody's having any trouble hearing me or anything like that, please go ahead and just kind of raise your hand and do that. So really for today, I'll kind of start with our Circular 230 notice. So anything you kind of hear about today is not anything to file for. Or, that's just kind of our normal Circular 230 notice that we have on the presentation. So you guys have that, read that, and we're all good to kind of move on. But really for today, I want to cover a few things. And, I'll try to keep it within an hour. We could probably do 45 minutes. If there are, a ton of questions, we might go to an hour. Feel free to stop me at any point if you do have questions, if there is something that we need to kind of go into deeper with that. But we're going to go through the proposed 174 regs that came out last September, and dealing with, more like with tooling and equipment or kind of depreciable items and how that kind of relates to research activities. Then we'll talk about the proposed 41 regs, which is the research credit section that came out in December about intra-group transactions and how some of that needs to be tracked now in terms of including that into gross receipts if you're on the regular credit method. And then we'll talk about a recent California research credit case appeal, and then we'll also talk about some things we're learning about the Georgia research credit, using it on the withholding, kind of an issue that we're facing and trying to get resolved with the state. And then last but not least, I know everybody wants to hear about the tax extenders legislation. And it's not anything that's fantastic, in today, but we'll kind of go through what we know and what we're hearing and kind of how we see things happening and doing that. So again, if you do have questions, if you do have any items that chime in through the conference number or just chime in through the chat. And if you can't hear me, or if something kind of pops up again, you can raise your hand, or as in the little status feature on the webinar. So everybody should be seeing the agenda slide now. We'll kind of keep moving on. So the 174 regs, we'll kind of start there first. The new 174 regs really kind of deal with three areas that the Treasury wants to update, and these have been proposed, and they've gone through the comment period. The hearing was last fall. It's a 90-day comment period, and then they usually have a hearing, which is a kind of a live comment period, and then they'll take time to kind of finalize those regs. So one of the big things that the first point is talking about success or failure of the item we're doing research on. So really, if anybody remembers, we've had a webinar probably about a year or so ago on the TG Missouri case, which was a Toyota supply chain company, and they essentially claimed research on tooling that they developed and then essentially sold to Toyota. So really what the regulations are and that was actually in favor of the taxpayer that they can do that. And really what the regulations are saying is that irrelevant of whether the product is sold or used in the business, that doesn't determine if it qualifies for research. So if you are developing a tool, developing a piece of equipment, developing whatever it might be, and you might ultimately sell that product, or you might use that in-house, right? If you might develop that tool to manufacture items in your manufacturing process, that does not non-qualify it, and it also doesn't qualify it. And so the success or failure of the sale, excuse me, failure, sale, or other use doesn't determine the eligibility under Code Section 174, but that does relate to Code Section 41. The TG Missouri case was actually under 41, what they were looking at. So when you're looking at tooling and looking at development, sometimes what the IRS would try to do is non-qualify items because you sold that item to the customer. And, that's essentially what all businesses are out there trying to do is sell items to customers. So that's the first item in the 174 regs that are there. The second item is what, is what they term the appreciable property rule. And the appreciable property rule is that something that that is there where if you look at it, if we're developing a piece of equipment or if we are developing an item that we're going to use in our manufacturing process, and we go out to we have folks in-house or we have a vendor, if it's $30,000 to develop that piece of equipment, and $10,000 of it is actually to the manufacturing or construction of the piece of equipment, and $20,000 is to the research development of that piece of equipment. What they're saying is that even though that $20,000 is kind of attached to that piece of equipment, that should not exclude it to be eligible for the research expenses. So the appreciable property rule is kind of, again, it's really just stating what has been there in the past, but you just have to really kind of educate, some of the times when you bring this through exam is that if I do have a piece of equipment or I do have a tooling or I do have things that we typically will think are depreciated, sometimes it's a mix of what is actually taken to construct cost versus what actually isn't to develop or the development cost of that tooling. And a lot of this, kind of comes out of that, if you think a lot of into the automotive supply chain or a lot of where there are multiple vendors or, tiered suppliers that are feeding up into the end product. Plastic, development is a big one where there's a lot of molding and tooling that goes onto there. But a lot of other products also go into that as well, or industries. So first was the selling or use of the product is not a determinant of qualification, as well as just because it is related to a piece of property or depreciable property rule, that shouldn't be used as an exclusion. The last item that is in these 174 regs would be, the pilot model definition. In pilot models, every company can have a different definition of what they term as a pilot model and what they would think that, would, be a pilot model. And so what the regulations was trying to, put a little bit of a definition around it. And what they say is that the representation or model that is produced to evaluate or resolve uncertainty concerning the product during its development or improvement. Not very specific. So that can be, you can have more something of a pilot plant or an actual kind of a bench model. It can be items that that you actually make or you construct or you evaluate to test and to resolve the uncertainty. So pilot models can be kind of, it can also be, models that we're doing electronic, but really the pilot model is kind of trying to put something that's a physical model. So we're going to build like a prototype car, we're going to build a prototype chip, or we're going to build a prototype, whatever that might be, if I use that term kind of interchangeably. That pilot model item was really just more of, I think, just a clarification from their standpoint. What they don't want is something that is a pilot model that is, well, it's really just manufacturing process. It's our manufacturing process, and then at some point in time we coin it a pilot model. But really it's our manufacturing process. I think some of the things is they want to see that you're using it in the development process, and really that's what it's there for. You're kind of making that happen. So those are really the big three items in the 174. Some of this is probably not new to those who have claimed the research credit or have been utilizing it, and especially if you're familiar with the TG Missouri case that's out there, it really kind of has come from that, the 174. Really, one of the things that we kind of said, well, when you're looking at your facilities or you're looking at your manufacturing, we thought, what are some of the questions that you would want to ask to see if any of this is going on? Because this is not typically going to get captured in your expense detail, because it's going to kind of probably, some of those costs are just going to get shifted into the item or the piece of equipment that's out there. So we thought to kind of go through some of these questions that you would typically ask to ask these facilities, more manufacturing type facilities, if they have any of this development that can also get included, for as a research expense. And first things first is it's kind of a two-pronged question. I know the regs really talked about the the prototype side or the development side, but there's a rights and risks component to it, especially when we're using a third party. So for qualifying the prototype or the tooling or the development, was there any new equipment or process tooling purchased in the year? That's kind of an easy one, as you guys are going out to your talking with your facilities on a year-to-year basis. To ask them, what was some of the tooling, and a lot of it's going to be existing. You can kind of get an updated asset list. That's usually a good starting point. And the next question is talking about, was it standard, or did you have to use a third party, or the manufacturer spend a significant time developing the equipment? So this is going to be more than off the shelf. I'll use that term very loosely. Is it going to be more than off the shelf and in getting areas of development that on this piece of equipment? So as you hear from this second question, some of these items might be asked of the actual manufacturing manager or the operational folks, rather than it might go beyond just the financial or controller individual. Second, once the equipment was brought to the facility, if it wasn't developed at the facility itself, once it was brought to the facility, was there further development testing? And the reason why we asked that question is so we can get a further sense of if there was further development going on when it was actually put in place or installed. Did they still have to do some evaluation and testing and some redesigning, or did it just kind of ship complete and you guys flipped the switch, for a simplified term, and then it was then it kind of went in and manufactured? So asking that question, was there any further development testing once it came into the facility? And then the fourth question, was there any failures? Were there any redesigning after the testing? Was there anything that came up that you had to redesign those items? So that's really kind of another question to ask. And again, these questions are really more of a preliminary items to kind of make sure you kind of ask some of the starter questions to see if you have any types of these equipment that have maybe some pieces of cost that can be pulled out as research expenses. Then lastly, was the equipment put in production? And sometimes what you find out is, no, it wasn't. It was maybe a big failure, or it was planned on putting in 3 months ago, but we're still working on it for the last 5, 6, 7 years. Sometimes things happen, and there could be reasons that are more technical than they are business oriented. And so you kind of ask those questions to see if maybe it was a complete failure, because sometimes that can happen. The engineering group or those technicians go out and develop this piece of equipment that's specific, and it doesn't work. It doesn't complete to the functionality, or there was a major amount of redesign cost that goes into that. Some of those pieces can be looked at to qualify. Now, the next area, which really wasn't captured in the 174 regs, but this is kind of the second component of qualifying these items, is the rights and risks aspect. And so if if we are a company and we need this tool in our process, and we go out to a contractor or developer or supplier or vendor, and we want to get that piece of equipment designed, we need to know that, hey, we have the risk in that development, where if we ask the vendor to design the piece of equipment, and we tell them that they need to design it and it meets all these specs, or else they don't get paid, fundamentally they probably have the risk in the piece. So we need to look at that, because we might be in some, in the flow of the supply chain for this overall product, we might have the risk or we might not have the risk. So first things first is you ask if there's an agreement. If it's a large enough piece of equipment that we're talking, could be millions of dollars, there's probably an agreement out there that defines those terms and who has the rights and who has the risks. Sometimes it's not. Sometimes it might be kind of an invoice, or it might be a purchase order that's out there that's really kind of defining the terms, and so you might have to use standard terms that are out there that are agreeable to. One of the things to look at is, does the company pay for any design changes separately outside? So you might pay, as the depreciable property rule kind of states in the example, is you might pay for that $10,000 of construction, but the $20,000 of design changes or anything like that, that's separate and that's on your dime. So we can actually separate out those two, which is good if that's outside the agreement. And then third, how did the manufacturer invoice the company for the equipment? That's just more of the kind of, it doesn't determine the qualification, but it shows the fact pattern of, was it just kind of a monthly standard invoice? What account does it get charged to? If it just gets to kind of a work in progress or construction in progress account, where does this expense go? Really just trying to follow the money trail of those dollars as they're getting in and charged into the company. So as you're looking into your organization, planning on research credits, those are the items that you would think about. And this is more going to be towards the manufacturing process improvement type activities that companies would qualify for. And that's really what the 174 regs are opening up or clarifying. So I'll pause here. And again, if you do have questions, you can chime in through the conference number, or you can chat in doing that. I do have a couple folks that joined that just gave first names, so we might send you a private chat just to make sure we know who has joined. But I will leave that pause for a second, and I'm going to take a sip of water and see if anybody has any questions. All right. Well, it sounds like everybody does not have questions yet, but we will keep moving on. And again, stop me if you have questions. And I know some of this is kind of the nitty-gritty details of the credit. This is less of the high-level kind of overarching stuff, but wanted to cover these regulations today just so we kind of get through them, and we can always follow up with offline questions. All right. So the next thing we're going to cover is the 41 regulations that we have there, and somebody's asking, the chat is covering the bottom of the slide. Okay, so let's see. So it looks like, let's see if I can do this. How about this? Move the chat. How about this? I'll move the chat off the slides for a second if that helps. Well, I don't know if that. Hopefully that helps if it does that. If not, I can just do this. I'm going to make the chat. I can make it smaller so. Hopefully that helps so it's not covering all the slides. If you guys can still see the chat. There we go. All right, good. Sounds like that's much better. All right. So the 41 regs that came out in December, these have a little, might be a little concerning from some standpoint. Some of the commentary that came out from the comments and the hearing and our kind of opinion on them could be a little tricky, and here's why. So, they're proposed end of December. Hearing was in April, and if you claim the regular credit, so if you're under the simplified credit, which is looking at the previous 3-year QREs, this really doesn't apply. But if you use the regular credit method, which is looking at gross receipts from the 84 through 88, or if you're in the startup rules, these can apply if you have intra-group transactions between your U.S. member and a foreign member. And what this is stating is that the Treasury says, well, there's a disconnect between the QREs and the gross receipts in this distortion, because you can have transactions that can happen and they won't get captured. So the first part of the regulations that I kind of pulled out that kind of are important. So the intra-group transaction between a foreign corporate member and a party outside the group involving the same piece of intangible property or tangible property or services that was subject to the intra-group transaction that is outside the control group does not give rise to gross receipts if they're effectively connected with the trade or business. And really what this is stating is that, so if we have company A, which is in the control group, and company B that with the control group, and we sell something to each other for research credit purposes, that's considered an intra-group transaction, and that would be disregarded from your gross receipts. But then what they're saying is, well, when I'm company B now selling to company X, which is outside of my control group, and it is in a foreign jurisdiction, they're saying because I'm making a sale of that same piece of property, then now that transaction that was intra-group between A and B now needs to be captured in the gross receipts. So that makes it a little challenging for one, and two, it gets very tricky if you are in these regular credit gross receipts rules. And so what they're saying is the statute provides no rules regarding this single taxpayer control group treatment. And so this is what the regulations that they proposed in December are trying to accomplish. So if I go to the next slide, So this long paragraph is kind of pulled out from the regulations. So if you have gross receipts, excluded, which is coming from, 141-6, and the foreign member, your foreign member is the second transaction, they're stating that those gross receipts are getting distorted because they're not, you're just shifting the gross receipts, or you could shift the gross receipts because the QREs of the domestic member, are included, but the gross receipts from the sale to the foreign member are not included. So what they're saying is that you include the gross receipts in this situation if that same piece of tangible property, intangible property, or services provided to the corporate member are sold off to a third party, a non-control group member. So it's not an intra-group transaction. Now, everybody who's probably thinking about this is thinking, oh, this can be, because now all of a sudden we have to start tracking these transactions beyond from the U.S. to my foreign member. It goes from that foreign member to who else did they sell it to. And that gets to be an exercise that, is really, we're still trying to figure out how we do that and how we make that, somewhat of a reasonable method or test to kind of determine that. So they're trying to include these additional gross receipts, and really saying that's a distortion, that you can distort this under the control group rules if you're using these gross receipts methods in these transactions. So you have to go in and now look at U.S. to foreign that are in my control group. Okay, even though I could disqualify that gross receipt, I now have to look at that next transaction from that foreign sub to the outside third party. Did they sell that to an outside third party? And yes, they did. Now all those gross receipts between my U.S. and foreign sub get captured in my gross receipts determination. So, and again, the thing that I guess for R&D credit individuals that might be a little tongue-in-cheek, they say that this is a narrow exception to the rule because the regulations retain the current rule that generally disregards the transactions among members of the control group, but this is a narrow exception. But if you're a foreign, if you have foreign ownership or if you have foreign subs that you're, doing these transactions or, these tangible or intangible pieces of items, this can be a very um, you know, arduous process or very difficult process. So again, the two things that go into it is the foreign corporate member, foreign control group member engages as a party outside of the control group, external transaction, and it involves the same or a modified version, and that actually we don't have a good definition in these regs of what that means because modified could mean a lot of different things, of the tangible, intangible property or service that was previously subject to the intergroup transaction. And the external transaction doesn't give rise to the gross receipts, but the internal transaction would. So they included 5 examples, and I didn't put any of the examples in here. If anybody wants a copy of the regs, you can email me, and we'll shoot you over a copy which shows the examples. It's just kind of as I'm sounding, and it kind of goes through some different items, and if there's partnerships or the thing that also is included is the transaction, the intra-group transaction of the gross receipts will get triggered to be included in the gross receipts when the external transaction is done. So what that means is in year 1, say 2013, I had the intra-group transaction. In 2014, I had the external transaction. Well, that 2014 transaction triggered the 2013 transaction. And what we don't have clarification on is when we pick it up is 2014, but it was in the 2013 year. How do we kind of include that? So then that's going to start getting included into my gross receipts average. And so that gets to be kind of a very, as you hopefully everybody's hearing, a really challenging process. So the questions that we still have, or we're trying to get answered, is how do you apply the consistency rule? And for those who are familiar with the credit, it'll sound very familiar, but the consistency rule is in the 41 rules. And what it says is if I have the rules today, so if I look at 2014 rules that applying this intergroup transaction regulation, if I apply this, I would have to apply it to my 13, 12, 11, and 10 gross receipts because that would make them consistent with those rules. Even though those rules did not exist in 10, 11, 12, 13, I would have to apply this rule to my gross receipts in those years in doing that. That's what the consistency rule is. It's the same thing with my base period now as well. Now, if you kind of understand now, 84 through 88, I have to look into those gross receipts and figure that out. That it makes it very challenging, if in fact maybe impossible for some companies to do that. Second, keeping track of the transactions and the year the foreign entity makes the transaction to an external party. It can be different for different companies, and sometimes what the U.S. is just worrying about is the U.S. to the foreign sub or the foreign parent or whoever that might be. They're not worrying about that second transaction. And so now this is if it is something that happens, this is for the U.S. credit. You have to look at those second foreign transactions, or it could be a tertiary, transaction that's out there in doing that. Our third question that we're kind of thinking about and looking at is, does this start linking some of your transfer pricing data to the research credit data? And, the IRS looks at both items. Are they starting, is that a way for them to kind of link these two together, saying, hey, this happened over the transfer pricing information, why wasn't it included in the research credit information, and vice versa? So you kind of really have to look at it soup to nuts to say, hey, do we have exposure in one area that's pointing into the other area that the IRS can use? I don't know if they've gotten that far in their thinking. These are just some of our thoughts that we've kind of, uncovered as we've been discussing these regulations, in-house, and we wanted to share with folks today. And then lastly, will you have to document that this transaction to the foreign entity did not sell or transfer to a external transaction? And what I mean is that if I look at this transaction for this tangible item, and I had a U.S. to a foreign that was an intergroup, they were in control group, that transaction, how do I have to prove that I did not have an external sale on that piece of item? That actually is another side of the coin that that they could ask is say, well, prove to me that you did not have an external sale on that tangible piece of item from the foreign sub to somebody else. That can that's a wide open kind of, that basically says every transaction to every person throughout the whole company needs to be produced, which would be a very challenging process or a very difficult process, and I don't think that's very reasonable. But that's something that could be asked, and I'm not saying that it won't be or it will be, but it's just things that we're thinking about as we see our exams and questions that we get asked on different items. And so those are the intra-group transactions that we have. I guess what I'm going to do is I'm going to open up a couple poll questions, and these will actually cover up the slide deck as we take another little break. If I do this, as you guys can kind of see, if you guys want to kind of answer some of and they're kind of in order, so as you kind of see them come across, go ahead and answer them if you're still with us. It'd just be interesting to kind of know what's out there. The first question is do you have intercompany transactions that span multiple years? That's a tricky item as things that things come out there. And are these transactions with foreign entities? So again, are we going from U.S. to foreign, and doing that? And then last but not least, are you filing for the regular credit, not the simplified credit, the regular credit using the gross receipts? And this is the one that will be applied to and be more valuable for. So I'm going to just expand the chat real quick while we're waiting here, and I have a couple folks that I've pinged with just making sure I know who you're with, or if you guys can look at the chat that's kind of expanded and let me know just so I know I kind of have a roll of who's here. And I'm going to just take another sip of water and we'll keep moving. All right. So any questions, again, just chime in or shoot through the chat. I know this is a very technical, very nuanced based item, and some of this, because it's current, more recent regulations, some of this is going to come out in more the planning aspect than actually kind of current compliance. But that's kind of where it's at. So I'm going to kind of keep moving on with the the presentation. We're about 40 minutes in. Hopefully I'll take another 10, 15 minutes at most. I'm going to slide off these polls here. It looks like a lot of you are kind of 50-50 in terms of the intercompany transactions, and yes, you do have foreign entity transactions that are out there, and maybe 2/3 are under the regular credit with the gross receipts. So it could be something that is, and if it's not something that you work with us, at least work with your current provider on making sure we cover these questions in doing that in the planning process, because it's just something to make sure. All right, let me move this chat back over. All right, so we should be. Now we're going to talk about California and talk about a recent appeal by Pacific Coast Builders. That's what PCB kind of stands for in this case. Is it's published out there. There's a lot of documentation that's out there on the case. To give you a background, and in California, the reason why we cover California is a lot of people have operations in California, and California kind of has their reputation of being kind of, they want to look at it just like the IRS. And I know a lot of people have gone through California research credit exams. So we thought it'd be just a good case to kind of just share some thoughts on it. This case was approximately $600,000 in refunds were claimed or submitted for 99 through 2004. Excuse me. The IRS allowed 100% when they looked at it, but it was just for the 2005 and 2006 time frame. And so, California FTB came back in. Actually, I think I have that on the next page. The case itself, I will kind of comment that the case itself does give a good background on some of the law and regulations of documentation requirements from a California perspective, and that's very good because a lot of the case law that you see is very federal oriented. Obviously, California is its own jurisdiction, and they have their own case law, and this is very good that their case law is very in line, kind of their perception of the regulations and things that are out there. Documentation requirements are very similar to federal case law, so it's not a disjointed kind of opinion. So if there's, it's a good, I find it a good read, but that's just, guess who I am and what I do in terms of giving some background and perspective. A lot of the 250 pages is dedicated to 64 projects in question for PCB. So, there's probably about 50, 75 pages that are kind of, really some of the meat of the items. But one of the things we kind of pulled out, which is kind of towards the end of the document, really what it is describing is just kind of an order of operations when you're looking at your research credits or when you're looking at doing kind of compliance and, hey, what qualifies, what doesn't qualify, how much of this. Really what they stated is for each of the projects, if you're looking at the business component or that term, if the project was qualified, met the 4 tests of technical uncertainty, experimentation, technological nature, and the purpose. If it doesn't meet those tests, then the analysis stops. In their mind, hey, if it doesn't qualify, there's nothing really to quantify because it doesn't qualify. So there's no, as they're saying, there's no need to determine the next steps of whether the expenses are attributable to the project. And they kind of go back into the Cohen rule and some, the old McFerrin case that was out there in the Shami case, in stating that, to use the Cohen rule, which allows you to approximate or estimate, I'll use those terms kind of loosely or in quotation marks if you could see me live, is you have to determine if the activities qualify first. If they qualify first, right, and you can show through documentation that they qualify, then you can go ahead and estimate expenses to it in doing that. And that's kind of what, those cases are doing that. So what they're saying is, FTB or first determine if a project qualifies, and then if they qualify, then they can take the next step into determining if they have expenses that are going to be attributed to the project. And that's kind of the, over the past few years with the federal, that's where, you're kind of focusing everybody's approach to making sure we can look at some projects, look at some business components, make sure we can see those things that qualify through documentation. And then how we quantify it, we have some flexibility. It doesn't always have to be time tracking. It doesn't always have to be all the way to the invoice level, detail. We can have some different ways of isolating it to a project or allocating it to a project. So that was something we pulled out from that appeal. The other piece on this, for a little bit more background, is FTB initially asserted that the PCB did not provide or not prove the process of experimentation, which is very similar to what the IRS kind of comes out as one of their arguments, is that the taxpayer doesn't prove the process of experimentation. Less of uncertainty, less of permitted purpose, less of the technological nature. Second was they said that the PCB did not provide sufficient documents, evidence of the experimentation. Now, I think the 64 projects that they went through in the appeal showed that they did. I think sometimes, and we get those same arguments on a federal level too. I think that's just something that they can do because the Section 41 and the rules, are there is no specific requirement, but the requirement is very general and broad. But once a taxpayer kind of proves that they have documentation, that really kind of satisfies the requirement. We can't always leave it general and broad as the appeal kind of states. So the one other interesting note was FTB actually first allowed the 1999 credit that was out there, only reduced it by about 80,000, and then I think what happened was they came back in and refunded for some additional years, and then they disallowed all of it and then went to the appeal. The other thing that the state board in this appeal kind of highlighted was that that if there was only oral testimony or declarative statements used that were not contemporaneous, they warned against kind of utilizing those as documentation. So again, kind of the order of operations, if we're looking at a project and determining if it qualifies, we have documentation. That should be the first and primary source. Second would be any contemporaneous, interviews or statements that might be there, and contemporaneous means closer to the actual, performance of the project. And less of 5 years from now, we do a study or do an interview, and all we have are what people say happened and no documents. They warn against using that, and that's very similar to a federal perspective to doing that. And that's something that, as you guys are looking at your if you don't use us for your research credit, that's always a question to ask, is if we're just relying on those oral items or that interviews or testimony, making sure we have documentation or something in place to show some of those qualified is really important, and especially capturing it now since it's easier than waiting. The state board kind of also kind of indicated that, hey, since federal already went through some of these items, and they applied it very similarly that the state board and appeals applied it. FTB was kind of behooved them to kind of say, hey, utilize those results that the IRS kind of already went through, rather than just kind of using the same arguments and the taxpayer having to go through the same type of process again and again in both federal and states, California or whatever states that might be. The one thing that they did, pull out was 10% of the QREs were actually not in the claim periods, so they actually were not. I think they were outside the scope, or maybe they were in 2006, not in 2004 or 2005. I don't remember exactly. But really, the important thing about the California appeal is that it wasn't different. It wasn't a hey, California should always do something different than the federal. Is really kind of piggybacking, some of the same descriptions and details that we would get from some federal exams that were out there. So that is the California item. I will stop for just a second to take another sip of water. If you have questions, kind of expand the chat, that are out there. All right, well, I'll keep moving on. All right, so now we'll move on to the state of Georgia, and if nobody has any further questions, we got a couple more slides, and we're just about done here. So if anybody files or has operations in the state of Georgia, let me move this chat back over. There we go. All right, so if anybody files for the research credit in the state of Georgia or has filed, for the longest time, the only way to use your Georgia credits was on your income tax, for your income tax liability. Then in 2012, they came up with the ability for taxpayers to use it against employee withholding, similar to a quality jobs credit or jobs credit they have down there, or a couple other different credits that they have available. So any QREs any QREs generated in tax years beginning after, or beginning on or after January 1, 2012. So 2012, 2013, and forward can apply to utilize those research credits against withholding. Now, as currently, we've gotten a few years into it. We've had a couple, taxpayer clients that have, created credit carry forwards that didn't originally, utilize or want to utilize those on withholdings. And their credits were generated after 2012. But what the state is coming back and saying, the ITWH, which is the withholding form to get approval, it has to file 30 days before the income tax return due date or when you file the return. You'll be disallowed. So what they're stating is that, for 2013, for, calendar year taxpayers, you're going to file your Georgia credit because it's a 9/15 date, if I'm not due date, if I'm not mistaken. You have to file that ITWH at least 30 days before that, so that would be 8/15, and you have to make a determination if you want to use that current year credit as against your withholding. Now, our argument back is, well, one, we need our federal, income number before we do our state income number, and also we need to figure out every other Georgia credit that we would have before we figure out if we have any excess research credit to use for the withholding. Because again, it's only the excess, the amount you would typically carry forward. That's the only the amount you'd be able to utilize for your employee withholding. So because the statutes do state that you need to look at when the credits were generated and both current and carry forwards to determine if those current and carry forwards can be used against withholding. But the state, we're trying to figure out to get some clarification of why they only read it as current year credits can be applied towards the withholding. So again, it's one of those things. If you file in the state, we do, and obviously, if you have operations in Georgia, this is something that we have some clients that are we're trying to plan for, because we have carry forwards that we, didn't realize we had for the withholding after the 30 days, and we would like to use those on the upcoming returns as a credit carry forward, and we want to get kind of that feedback from the state. So, if you do have something in Georgia, or if we need to, discuss this offline, give us a call or shoot us an email, and we can kind of let you know what we're thinking or where we're at, or kind of, put a little short list together, because, other folks are kind of, running up against us as we're getting a few years behind or beyond the 2012 timeframe. So that's the Georgia, withholding. And just keep in mind is, from a planning standpoint, what this means is you have to know 30 days before you file that state return if you have excess research credits, and that means you need to have your federal and state tax, income tax, liability determined. And most of the time, I would believe that you determine your federal income tax, and then you get to your states. Obviously ones that you need to get to, but it's going to be closer and closer to the due date rather than 30 days before. So if you are planning things that, this could be an issue, just think about that and what you want to do, because there's different scenarios that we've thought up, and we're trying to work with the state, but those are the items. I was going to put this poll question out there about, when you file, but as I was thinking about it today, we're going to skip this one. I think, it's just more of a not necessary. And I don't think it's worded very right. I think we're just get kind of inaccurate answers. All right, last but not least, I think everybody, and if anybody have any questions on Georgia, California, or anything else we have today, last but not least is kind of a little bit on tax extenders. Okay, I will move on. All right. So the tax extenders. So the Senate Finance Committee bill that's out there, and a little background is that, the tax extenders is a package that comes out every 2 to 3 years in Congress. It includes the research credit. There's other deductions and items that are out there, um, and credits that are out there that are included on there. Includes like, for sake of example, like an individual item would be like teachers deducting supplies for school. That's another piece of the extenders. There's a bunch of different things out there. Research credit is probably the biggest one that's on these extenders package. This has been going on since the research credit was enacted back in the 80s. So it's been through many, many extenders. And, I personally have gone through probably 7 or 8 of them. I don't know how many. It seems like every time it's coming up, it's there. And the Senate Finance Committee is probably the biggest, committee to kind of put something out there this year. They approved an extenders package probably a month or so ago. And then last week, I think May 15th is last week or maybe the week before, it was blocked in the Senate. Blocked because it was denied amendments, blocked by the Senate Republicans because the Senate Republicans were denied by the Senate Democrats to put amendments to the bill. Now, you can read the commentary if you want to about what they, why, and again, I won't get too much into the politicalness of why things are it, but it's more procedural and how they're trying to work things out or not work things out. There's always been bipartisan support for the tax extenders and obviously the research credit. You've probably heard it in every, there's been, President Obama, Bush, and, if we go back even farther, have always kind of said to make it permanent, but that's always just been part of the, State of the Union address, at least one of them I've heard. But the thing is the upcoming midterm elections have intensified debates, and it just seems to get earlier and earlier. These elections that come into play get, more and more involved. And I don't want to share any kind of, political, skewness of why this or that, but that's just kind of it. I mean, really, it's just right now we're getting into a time period, getting into the summer months where things are going to get, ramped up for these November elections that are coming out. Our estimate, though, from talking with, folks that we, and kind of, our best guess on doing that is it's probably either it's right around the election or, after the election before the end of the year, which was what happened last time. Was literally, I think it was, a couple days before the new year happened. I think that's the boat we're going to be in again this year. That happened about 2-3 years ago, and that's just kind of the, the place, that's just kind of the realm that we live in with these the extenders and specifically the research credit. So that's it. That is the kind of the webinar today. I've got a couple folks. If you want to check your chats before you jump off, make sure you let me know kind of where you're from or who you're with, just so I know that piece. And otherwise, if you do have questions or you want to kind of talk further about any of the items we talked today or any other pieces of the research credit, we kind of that's our specialty. And our next webinar is going to be probably July, August timeframe. We'll see, in terms of some topics that are coming up. We kind of want to get some good topics out there. And if you feel, hey, I want to, it'd be great to have a webinar on this or a webinar on that. Let us know. We can kind of, if there's a bunch of you that kind of want to talk about some certain items, we'll do a webinar in doing that. But that's it. If anybody has any questions, I will open it up for questions or comments and take a second to see if anybody's got any questions. All right. Well, I appreciate it. We're going to post this webinar probably in a few weeks. So if you look at that, I appreciate everybody joining on here. Other than that, I think that is it, and we will end the webinar.